Are you tired of wild crypto price swings? Imagine being able to protect your investment from market volatility while staying in the crypto space. Well, that's where stablecoins like USDT come in. In this video, I'm going to break down what stablecoins are and how you can use them to safeguard your investments during market volatility. Let's dive in. But before we get started, make sure to hit that subscribe button for more clear and practical crypto tips. If this video helps you, give it a thumbs up and let me know your thoughts in the comments below. Let's help each other out on this crypto journey. 1. What are stablecoins? Alright, so let's start with the basics. What exactly are stablecoins? Stablecoins are a type of cryptocurrency that's designed to have a stable value. Unlike Bitcoin or Ethereum, whose prices fluctuate dramatically, stablecoins are usually pegged to a reserve asset like the US dollar. For example, USDT, also known as Tether, is a stablecoin that's pegged to the USD on a 1:1 ratio. So 1 USDT equals 1 USD. 2. Why stablecoins are important. Now, why is this important? One of the main reasons crypto investors use stablecoins is to protect their funds from market volatility. Let's say the market is crashing, and you don't want to sell your crypto for fiat, traditional money. Instead of cashing out, you can convert your assets into stablecoins like USDT. This way, you can hold your value and jump back into the market when things settle down. Example: Bitcoin is dropping fast, and you're worried about losing value. Instead of selling it off and withdrawing cash, you swap your Bitcoin for USDT. When the market recovers, you can easily convert your USDT back into crypto without any major losses. 3. How to use stablecoins in your portfolio. Okay, so how can you actually use stablecoins in your portfolio? Here are some common strategies. Parking profits. After a big run-up in the price of a cryptocurrency, you can convert your gains into stablecoins like USDT to lock in profits while staying in the crypto ecosystem. Liquidity provision. Many decentralized finance DeFi platforms allow you to lend out your stablecoins to earn interest. This way, while your assets stay stable, they generate passive income. Buying the dip. Stablecoins allow you to act quickly when there's a market dip. You don't have to wait to deposit fiat currency. You're already in the crypto world and ready to buy low. Now 4. How stablecoins add stability. Now let's talk about stability. Crypto is known for its volatility, but stablecoins can help balance things out. For long-term investors, stablecoins can act as a safe harbor during storms. They provide an easy way to ride out the ups and downs without pulling out of the market completely. Example: let's say you're holding Ethereum and the market is experiencing a downturn. You can transfer your Ethereum into a stablecoin like USDT to preserve your wealth until the market recovers. Are there risks? But hey, no investment is without risk, right? While stablecoins offer more stability than other cryptos, they aren't foolproof. Some risks include regulatory changes and the risk of the issuing company not having enough reserves to back the coins. So always do your research on the specific stablecoin you plan to use. Here's a bonus tip. Always ensure you're using a reputable stablecoin. USDT is widely used, but you can also consider other options like USDC or DAI, which have different mechanisms and are issued by different organizations. Diversifying even within stablecoins can help reduce risk. If this video gave you some clarity on how to use stablecoins to protect your investments, be sure to like this video and subscribe to 1 in a Million for more crypto insights. Have you used stablecoins before? Let me know in the comments below how they've helped you during volatile times. Thanks for watching, and remember, stay smart, stay safe, and stay diversified. See you in the next video.